Good evening, everybody, or good morning, wherever you are watching from today, and welcome to this webinar where we're going to have a look at the three top strategies using moving averages. And we, of course, will try to demystify some sort of strategies that I have been using for years now. And the best thing actually would be the combination, because there is going to be three strategies actually we're going to talk about, but the best thing is going to be that in the end we're going to combine all of them together to make a super sort of strategy based on moving averages and other tools, of course, because using moving averages on their own is not really recommended. So we're going to do a little bit about the basics. We're going to compare the different types of moving averages and understand what are the benefits and what are the disadvantages using them. And we're going to use them, of course, then in combination with other technical indicators, MACD, the RSI, and also the Bollinger Bands, which are made of the moving averages, but a moving average, I would say. And then, of course, we're going to go into the strategies themselves, one by one, individually, and sort of bring them all together to make the super strategy of the moving averages. So without taking much more time here into the introduction, we are going to see the agenda being all about the beginning, actually about the types, benefits, and drawbacks of moving averages. Then we're going to look at the most significant sort of signal that the moving averages can do when in combination. It's not really recommended to use one moving average on its own, and this is of course the MAC or moving average crossover, some examples and some tips. Then we're going to look at the moving averages and the indicators that we have built the strategies on, and then we're going to have some real examples using just one pair actually, which is so easy to find opportunities like this on just a simple chart on a certain period of time only. Like the time frame was just like maybe a few weeks or few months time frame. So let's get started and have a look at what are moving averages. First of all, it is a technical indicator, obviously, and it's used to smooth out price and other data over a given period of time. Okay, it takes the data from a specific number of periods. For example, how many it adds, what is the look back period actually will call. If you want to look back at 14 days, it's like you to use a 14 periods or any sort of time frame you have. If it is 14, might be 14 hours, 14 4-hour candlesticks or anything else. What it does is you pretty much just take the prices of the past, let's say 14 days over here, and then divide it with 14. So it's just simply a very like how you work out a mean. Okay, if you are into, like, if you remember just math, simple math from school, this is what it is about, and it helps kind of clear the picture because it gives you an average price over a certain amount of time. Generally, now when the price moves above the moving averages, we say that the trend is to the upside, and when prices, of course, move under the moving average, now we do say that the trend is down. It also, of course, matters what sort of period you're using, because if you are using the 2 or the 3 moving average, obviously that doesn't really tell you much about the trend. Okay, here are the 3 different types that I am mainly have used in the past and mainly focused on. The simple is what we just saw. The exponential one is for those who are up to being a bit more like trading a bit more risky, so the risk appetite is a little bit larger than other traders. And you also have the weighted moving average, which is kind of one that is used to reduce the lag. And the lag, I don't want to go into the lag itself because it's not easy to explain without going into math. And just think of it of this. Sometimes when the candlestick is closing, okay, it doesn't necessarily mean that the moving average will remain on this certain level that it is based on the previous, of course, prices. It doesn't necessarily mean that is going to remain at this particular price. So when the changes are happening every candlestick, okay, without taking into consideration any changes that have happened in the past because of the moving average lagging. Okay, so exponential, it doesn't it doesn't really, I mean, it still lags, but it's moving faster than the simple. Okay, that's why it's made actually for short-term trading, because it puts the weight on the most recent data points. You see that in the formula here. And that, of course, makes it a little bit more sensitive to price changes. Hence, if you don't have a good strategy, actually, it's going to lead to more losses than anything else. And then the weighted, it just gives more weight to more decent or more recent data points, as well as the exponential does. However, it also gives weight to older data points. So it smooths both the current, the closest recent, the recent most recent data. Also, it weighs all the other data based, of course, on the period that we're using. Okay, and this is how you can have, of course, the best version of a moving average, which is the weighted WMA. If you want to have like the sort of clearest signals, this is the one to use. Now, what are the benefits of using moving averages, you may wonder, because maybe you just put it on your charts and you're like, yeah, what am I supposed to do here? Well, you can do 4 things mainly. You can identify trends, as we said before, based on where the price is in relation to the moving average, if it is above or below. You can use it to identify different support and resistance levels, and that could be in between 2 different moving averages as well, or it could be the moving average itself. Okay, and especially when you're in a trend, when prices are coming towards the moving average, that is considered to be a mean reversion. And when we get to that level, exactly when there is a retest of that moving average, this is when we are going to get signals on whether the trend is going to continue or is going to reverse, or it's going to be deeper, perhaps even. The other thing is that we can confirm market trends, okay, by comparing the slope of the moving average to the direction of the trend. For example, you might see a slope like going all the way up. It has, like, let's say 45-degree angle that is pretty much right in the middle over here, right? But then you compare you have another moving average, which is maybe a little bit slower, and it's going to give you a different slope, maybe let's say 30 degrees angle. Okay, so this if prices remain between 30 and 45, that means that the continuation of the trend is more likely than if the slope would be, let's say, less on the lower moving average. And then generating technical signals, because you can use a single moving average, or you can look at the MAC, as I said before, moving average crossover, between 2 moving averages or even more. Okay, some people use 3 moving averages, which is a very good technique when you are a swing trader, because you can use the 10, then 20, and the 50, let's say, moving averages, and you can identify short, medium, and long-term trends. So what are the drawbacks, though, of using the moving average? As we said before, because we do have some sort of lag, they are very susceptible to whip shows. They can, for example, imagine price is like closing above the moving average, and you think this is a signal and we're going to get a breakout to the upside or to the downside, and then suddenly the next candlestick you see the full reversal. This is when it provides, of course, false signals. There is an abundance of signals. Of course, it depends on what sort of time frame you use as well. The lower the time frame you use, the more signals you're going to get, which means the less the accuracy is going to be on the signal that you're looking at as well. Okay, that can also lead to over trading, and when you over trade, of course, you can risk too much of your capital. Whereas when you use the most common moving average periods, and that's why they are most common, because most of the people in the community of moving averages trading are using them for kind of having into mind how much risk they want to take for a particular signal. And then, of course, number 3, the other drawback is you can use reliability. As the trend progresses, the moving average becomes less reliable, so it takes longer to respond to price changing. This is for overextended trends. We're talking about trends that you might see, for example, a move to the upside and return back to the moving average, and then continuation of the trend and return back to the moving average, and then another move to the upside. This is typically three waves that we do see extensions of a trend. But if you go above that three and there is a trend that is, it doesn't matter if it's accelerated or not, to be honest, but if it continues for a longer period of time, or for a long period of time in general, then it loses reliability. Okay. Now, the most common moving average periods are the 10, the 20, the 50, and the 200. And to be fair, the 200 is not used as much as the 10 and the 20. The most typical one would be the 20. The 10 is for very short-term trading. Okay, maybe even some like scalpers use even the 3 or the 5. Okay, the 20 also is for short-term, but you know, there is a bit more, you know, when you take into consideration that there is double the quantity of data that you're using, also the quality of the signal is improving. And then you've got the 50, is for medium-term trends and intermediate traders, maybe swing traders as well. Depends on whether you're looking at the hour or at the 4-hour or at the daily chart, you know, because you could be using the 200 moving average on the 1 minute time frame. That doesn't mean that it's more accurate, okay? And it shouldn't really be like considered because you got a very huge gap between the two. You got the 1 minute and you got the 200. We're talking about 1/200 ratio, and that shouldn't be the case. When you're looking, for example, you could probably use like for the 1 minute, I mean, you shouldn't really be doing anything, but the common sense is that if you're going to use the 1 hour time frame, then you should use the 20 period or the 25. Okay, the 20 period means that you get 20 hours, and this is pretty much you're looking at a full day, you know, if you have the 25. So equally, that should be a similar case if you're a medium-term trader. You should be looking for the combination of the period and the time frame to make up to around a week. For example, if you see at the 50, you know, if you do the 50 day, for example, it's 52 weeks. You know, you got nearly 1 year. So you know, this is how you should consider it. And the 200 is used mainly for the crossovers. Like the 200 and the 50, you have the golden cross and you have the death cross, which we're going to actually look at some point lower down in the slides. Now, signals. I mean, as I said, the most typical is the crossover method. What is the crossover method? It is a strategy that looks to capitalize on changing trends by identifying when two averages cross. Okay, one over the other. It works by taking two different moving averages and looking for a crossover between them, up or down. When the shorter term crosses above the longer term trend moving, yeah, then this is interpreted as a buy signal, and of course vice versa is for the short signal. When the two moving averages though are close to each other, okay, and markets are looking a little bit flat or sideways, they can give so many signals that they are false, okay, and they actually result they don't actually result in a trend change that is considered to be lasting like more than a day, perhaps even sometimes. So what are the most popular moving average crossovers? As we said before, the strategy is to moving average to signal a possible trend shift. The strategy looks for a crossover between the 50-day simple moving average and the 200-day simple moving average. When you're looking at the 4-hour on the 1 hour, I mean, if you want to still call it death cross or golden cross, it's up to you, but the strategy uses the daily chart, okay, or the two strategies. But let me just also remind you or tell you something, that nothing should be really based on a simple crossover. This is not trading, guys. A simple crossover is not an actual strategy. We'll just go with what the common tools are and how we can use them, and then we are going to fix them. We're going to improve that strategy. Now, if the 50-day SMA crosses above the 200 SMA, it is a signal that a bull market may be forming, and traders should look for buying opportunities, and that is the golden cross. Yeah, golden era. Market is rising. If the 50-day crosses below the 200 SMA, then that could indicate the start of a bear market, and traders should look for selling opportunities instead. That is considered to be the death cross. Now, let me give you some real-world examples of crosses. We have one in 19 where the 50-day exponential moving average for the S&P 500 closed below the 200-day exponential moving average, and that generated a sell signal. Now, look at this. If you had invested 10,000 back then, you have avoided a loss of 1.5K by the end of the year, if you knew about the actual moving average. Now, in 2020, another signal, the 20-day moving average for Apple crossed above the 50-day moving average, generating a buy signal. So this could be considered a golden cross, but we're looking at different periods. A 10,000 investment in this case would have a returned profit of 2,500 by the end of the year. This is a 25% increase, guys. 25% increase. So as you see by the two examples, the one is the example that would give you profits, and the other one is an example that if you would know about the death cross, you would have avoided you have avoided a loss. You could also short sell, obviously, but I'm just pointing out that it can be used for both ways. And we have had also the double crossover method for Bitcoin. In 2021, the 50-day moving average crossed above its 200-day moving average, generating a buy signal at 10,000. Investment will have returned a profit of 5,000 by mid-year. Okay, so if you've got a 50% upside by mid-year. Okay, this is like, okay, you know how volatile, of course, cryptocurrencies are. That includes the volatility of commodities as well, because typically this is how we relate the cryptocurrency markets mainly to commodities. Now, here's I want to give you a few tips about using the crossover successfully. Okay, as I said before, of course, we're just not talking about what other tools we're using here or how to improve the moving average crossover strategy, but we're just talking about these three different things that have nothing to do with other tools. Number one, actually, these tips should be really for everything, guys. Context. Before entering a trade, okay, be sure to consider the overall context of the market. Okay, maybe you're looking at 14 periods and you have a trend, but if you have like 100 bars on your chart and you're looking at the 14, and the 14 are showing a bullish trend and like the 86 are showing a bearish trend, obviously you've got an 86/14% ratio there, that the 86% shows, for example, a bearish trend and the 14% shows a bullish trend. So you gotta look at all the data available there, okay, not just focus on the periods that you're looking and the moving average. Another thing, confirmation, using additional indicators, okay, or even chart patterns to confirm the signal before executing a trade. I will give an example. Let's say you have the inverse head and shoulders, okay. The inverse head and shoulders, the way the pattern works is that when you break the neckline, probably on the way up to the right shoulder or after the right shoulder, when the inverse head and shoulder is complete, you're gonna get the moving average crossover as well, or maybe sometime between, it depends on how deep the opposite head is, because you look at the distance of the head from the shoulder to the head as well, and you also look at the neckline, okay, because you got time and you got price. There is two components in every single chart that you're looking always. Most of the people tend to forget that time is also important. But anyway, yeah, confirmation is very important. Okay, so you should know, for example, that okay, we have had an inverse head and shoulders here. We should be expecting moving average crossover. If you're not going to see the crossover, then you know that probably that's not an actual inverse head and shoulders as well, and that helps you with whatever decision you want to make later. And monitoring. We don't just open a trade because a crossover has just appeared and we just let it go until we decide to take 10% or 15% of the market. These numbers are very random, and I mean, okay, it might be the way of you doing things and it works fine, but it's always better if we have we monitor the market, because maybe you have 2% target maybe it's going to go up to 198, and you have to watch that, because it would be a shame to leave all this profit on the table. And equally, you might have your stop loss at a place where it's going to be taken out fairly quickly. So you can either cut it short, or you can either just maybe widen the stop loss a little bit, because you do see some sort of signals there that that trend is going to change fairly soon. Now, let's just go and combine, confirmation, we talked about it. Let's just go and combine a little bit with the moving averages and the indicators. Okay, we're going to talk about the RSI, the MACD, and the Bollinger Bands, because they all actually do something different. The RSI is a momentum indicator, okay, and the MACD, of course, but we're looking at them to generate different signals for us. The RSI looks at strength of the current trend, or the weakness, of course. When we have overbought and oversold levels, okay, combined with moving average, they can be used to enter and exit trades, as well as to confirm breakouts. So look at this. We are looking at the strength of the trend. So mainly our focus will be on breakouts, because most of the people are confused with the RSI. The RSI is good to do reverse trading when you are in a ranging market. But when you are in a breakout market, you're going to go and be overbought at the breakout. Okay, and obviously, preferably the breakouts are the one that lead to bigger moves and bigger risk, bigger rewards, rather than just what the sideways markets will give you. Because sideways also have a lot of false breaks, in purpose, of course, to take out a lot of stop losses. And the MACD, also momentum, can be used to look for changes in momentum. Okay, we will analyze divergences between the MACD lines and also the histogram. Okay, we're going to explain how the MACD works as well. And then, of course, we identify how we can enter and exit trades, as well as confirm pullbacks. And again, here, the pullback, it's something like of a mean reversion strategy. But also think about this. If you're going to have a trend to continuation, you're going to get pullbacks in this trend continuation. The pullbacks can be traded, but also they can be setups themselves to trade the continuation, right? And of course, Bollinger Bands, one of the most important indicators that there is, and this is not, I'm not overreacting or overstating anything. It uses the actual moving average itself, and what it does, it creates a band around the moving average with two standard deviations actually away, higher or lower, creating the upper Bollinger Band and lower Bollinger Band, which can be identified, of course, can be used for support resistance levels, not just the bands, but also the moving average itself. When we use the Bollinger Bands, we can also get a lot of confirmations for buy and sell signals. Okay. Now, what are, of course, the pros, but there's also cons for using the moving averages and the indicators. Pros first. Pros are a different type of thing. They can help provide more reliable entry and exit points. Okay, this is very important. They may help confirm the direction of the trend confirmation, and they can potentially improve management of open trades, which comes back to monitoring that we looked at before over here. Okay. Now, when it comes to disadvantages, they may generate false signals due to conflicting indications. Okay, because sometimes you might get the RSI showing one thing and the MACD showing another, and then you'll be like, okay, what are we going to do here now? You've got two signals, and it's up to you to decide what to do. But the best thing, of course, is that if there is conflict, then you leave that trade. They may make the strategy more complex and difficult to execute, because you've got more steps to tick off as you go, and they may result in missed opportunities due to lag. Depends on what sort of moving average you use, of course, what sort of period you use on the RSI, on the MACD, or on the Bollinger Bands. Okay, now some of course I would say, because the MACD uses the exponential moving averages, it's a little bit less laggy than the RSI. And when it comes to the Bollinger Bands, I would say they're not lagging. Well, everything lags, to be fair, due to the formula, how it's calculated, but I would say this is the least lagging version of an indicator when it comes to the Bollinger Bands. But the least, or the one that doesn't like, is actually the ATR. Obviously, we're not going to use it here. The ATR is typically used for risk reward and working out take profits and exits. Ultimately, the decision to combine moving average with indicators will depend on the trader's personal preferences, risk tolerance, and trading style. I'm not here to show you what you're going to use. This is up to you. I'm here to tell you how I'm using those tools and how I have actually used them to create strategies that work. And from there, you take and use what you want in order to complement your own strategy, or backtest my own strategy and see how it works for you. Now let me show you an example of the RSI and the moving average. Of course, the RSI, as was said, we're looking at the 70. It's overbought, and the strength of it may be increasing. When we are below 30, indicates securities have sold, but also that the strength of the trend may be increasing as well, because we're looking at the downtrend. Now, by combining the RSI with moving averages, traders can identify potential breakout points by looking for RSI readings that indicate an overbought or reverse condition in conjunction with potential trend change, as indicated by the moving average crossovers. Okay, for example, if the 50 is, if the 20 is above the 50, we do know that we're moving up. So when we get overbought, we do know that the strength of that trend is increasing. Okay, that's the point here. We're not looking for, well, we are overbought territory, let's sell. We're looking at the opposite. Okay, just keep that in mind. When it comes to the MACD, we can see how pretty much the momentum is weakening and the prices might be about to reverse for the short or for the longer term. That can be a full-blown reverse or just a pullback, which is also called mean reversion. Let's not forget. Now, by combining the MACD with moving average, trends can identify potential pullback points by looking for MACD reads that indicate a divergence in conjunction with the potential trend change as indicated by the moving average crossovers of the MACD. Okay, because let's not forget, the MACD uses the exponential moving averages, right? The line, as we call the signal line, and you got the crossovers of the MACD. This is the actual crossover. So we're not going to have to put any sort of other moving averages here. We're going to use the MACD ones, okay? And this is the actual crossover. At the same time, we're going to use the zero line, okay? Because the zero line says momentum is negative, which means we are more bearish, or momentum is positive, or we are more bullish, okay? But mainly, we're going to use it for divergences, okay? Because when momentum is weakening and prices are moving up, it means that there is increasing selling pressure, or you can say there is, well, less momentum to the upside, so less buying pressure to the upside, okay? And when it comes to the Bollinger Bands, we are measuring volatility. So you see, all of them are doing different things. We are looking at the strength for breakouts. We're looking at momentum exhaustion and divergence for pullbacks and perhaps continuations, not perhaps, definitely. And we also look at the volatility, which is very, very, very important, because if we don't have volatility, there is no breakouts, okay? So when we are near the middle of the Bollinger Band, which is actually just the 20-period SMA, the bands follow a pullback. Okay, this is an indication that the current may still have some momentum and could continue higher depending on the slope of the bands and of the moving average, of course. By combining bands with its mean, which is the moving average, traders can identify potential continuation points by looking for the price to move back towards the mean in conjunction with potential trend change as indicated by the moving average crossovers. Okay, again, we're using a crossover here. Let me tell you something. What I'm saying here is that when we're looking at the Bollinger Bands, we can look for pullbacks, which is one of the trade generation sort of signal, or the signal generation is to the downside or as a pullback. But also when the pullback finishes, we can look at the continuation of the trend. Okay, so we're interested in both things. Now, we have some time to go through the 3 top strategies. Okay, so we're going to be looking for the RSI and breakouts. Okay, we're looking for the 20 SMA cross above the 50 SMA. Okay, and the RSI to reach overbought or oversold territories. It's not just as simple, but this is the basics, just so we have a good understanding. We're going to look for pullbacks and the MACD, okay, and the divergences, of course. Again, the 20 SMA should always cross the 50 SMA above or below, and we're looking for MACD divergence or hidden divergence as well. And when we're looking at the Bollinger Bands, we're looking for reversals and as well as continuations. The 20 SMA again should cross above the 50 or be above the 50 or below. We're looking at the Bollinger Bands at the upper, okay, and the lower as support and resistance. So the upper Bollinger Band is going to be resistance, the lower Bollinger Band is going to be resistance. Also, let's not forget the median line, which is the actual moving average, is also going to be used as an actual support or resistance based on what sort of direction we're heading, and that will be also used as a setup for the continuation of that particular trend. Now, let's have a simple definition of the term so we do know what we're talking about. Okay, what is a breakout? A breakout is when the price of an asset moves beyond a level of support or resistance, signaling a potential trend continuation. Pay attention to this. Breakouts are not confirmed when prices close above the support or the resistance. It is a breakout, but it's not confirmed. If you see prices reverse, that's going to be a false breakout. If you see prices going above for 3 more candlesticks and staying above that particular support or resistance level that just broke, this is the confirmation. 3 bars. I mean, on the daily, when we look, it should be, price should be above or below this, the resistance or the support for 3 consecutive days. Okay. Pullbacks. The pullback is when the price of an asset moves against the current trend and retraces a portion of the prior move, just a portion. This portion could be 38%, 50%, 62%, but the less or the smaller the pullback, the more the momentum remains to the direction of the trend. Okay, now of course, when we do get that pullback, there is a slowdown in the trend. This slowdown will either end up being a reversal, which we're going to see now, or we're going to stop, receive a retest, a rejection, and further continuation to the upside or to the downside, depending on which direction we are heading. And when it comes to the reversal, is when the price of an asset changes direction completely after previously moving in the opposite direction, signaling the potential trend change. So, for example, when we lose the moving average, or if we look at the Bollinger Bands, the bottom, if we're heading up and we lose the lower Bollinger Band, that pretty much is a trend change. But also the crossovers are the ones that are going to be used for that. Now, a little bit of an overview of the strategies. Moving averages are popular too, of course. It can be used for a variety of trading strategies. Breakouts, pullbacks, and inversions are some of the most common types of strategies that traders use with moving averages. Breakout, when price moves above or below a moving average, and the RSI goes overbought or oversold. Pullback, when prices retrace to the moving average or a standard deviation, if we're looking at the Bollinger Bands, after a MACD divergence. After a MACD divergence, we always look for these signals, guys. And reversion or continuation, because both can be traded when price move under or above a moving average or its standard deviation. Now, the generation process, as always, identify, evaluate, confirm, and manage. Identifies the ability to identify signals when looking at the charts. The eye needs practice to get trained. Practice. Evaluate, quickly evaluate how reliable the signal may be, which in turn improves the accuracy of your system. Typically, the first thing you see, that should be it. Don't overcomplicate things. Confirm, the ability to confirm how good the signal may be, using a completely different set of indicators or price conditions or any set of rules. Okay, and manage or monitor, as we said before, that is when we have to monitor to manage. The ability to build a system that uses indicators in a way to manage the trade for most gain or less loss. Breakout conditions. The 20-day simple moving average has to be above the 50 SMA to be in a bullish trend, vice versa for the bearish. Now, we have to look at the daily chart here and the 1 hour chart, guys. This is an intraday strategy, but we need to be in the direction of the trend. So we look the 20-day above the 50 on the daily. Then we'll go down on the 1 hour. We'll look at the SMA. The 20-hour should be above or when it's above the 50, it's a signal for a long position, and the other way around for a short. The RSI goes overbought, that triggers a long position. The RSI goes oversold, that triggers a short position. The entry can be at breakout, but it's a little bit risky, or you can wait for the confirmation if you want, or for the retracement. This is the magic about these strategies. All of them, if you don't get the breakout, you're going to get the pullback. You can trade the pullback, or if you don't trade the pullback, you can trade the continuation. Or if you don't trade the continuation, you can trade the reversal based on the signals you get. Okay, so this is it. You're either going to get a breakout, a pullback, or a reversal, or a continuation. These are the 4 things that can happen in markets. Now, entry at breakout, it's for a very quick sort of, typically it will give you good risk to reward ratio anyway, so that's why the entry is a breakout. Stop loss below or above the hourly moving average crossover. So you're going to go to look at the crossover, okay, and you're going to put it, if you're in a long position, for example, you're going to put your stop loss below where the crossover is. Okay, now in one case 20-hour SMA below the 50-hour SMA, and the other case 20-hour above the 50-hour SMA. This can be like the exit, okay, but of course that depends on you. You can also use the RSI crossover, like below the 50 or above the 50, or even just let the trade run to the opposite direction of the RSI. But this is purely using the RSI and the moving averages to simply enter and exit trades. And we use the RSI for both entering and exiting. For example, look at this. I am on the daily on dollar card. I see a crossover. Okay, or no, I don't see a crossover. I do know that the 20 SMA is above the 50 SMA. So what does this mean? We only take long positions. Right. Now I'm going down to the 20-hour. Okay, it's the same exactly chart. Okay, and this is exactly where the crossover happened. Okay, I have this line over here for that reason. Now look, this is the first time that the RSI went overbought after the crossover. Okay, so this is where we're looking for the potential entry, right? And we are the 20-hour SMA, which is above the 50-hour SMA. And this is actually the breakout level, guys. So this is our top. This is the resistance break. Okay. Now look at this. If we enter at that price level, which is the breakout, okay, and we're going to put our stop loss just below the moving average crossover. This is the 20-hour moving average crossover. Our stop loss is just a little bit below. And look at this. Our take profit is up at like 2.64% higher, which is a very good, very, very, very good trade. And where is the exit? At the opposite moving average crossover, as we said before. So we'll let market go up, and this would be when we would close. You know, the other thing to do is you can close when the prices go below the 50 RSI. Okay, there's 2 options. You can use both or either. You know, it depends on how it works, you know, or how comfortable you are leaving that trade, you know, because the RSI 50 came first. So, and pretty much would offer a similar risk to reward ratio. Okay, so let's go to the pullback strategy now. The 20-day SMA above the 50 SMA and pullback after the moving average crossover of the, you know, the exponential moving average, of course. Then you got the 20-day SMA way below the 50 SMA, the pullback after MASC again. We're going down the 1 hour, the MACD has to be above 0 and diverges. That is a signal short, a short signal, or the 1 hour MACD is below 0 and diverges, then there is a long signal position. Now, 1 hour crosses 0, that triggers the short position. 1 hour MACD crosses 0 line, again, that triggers the long position. Okay, these are conditions. These are the conditions, and this is, you know, what is going to trigger the actual short or long position, because we want to see the divergence first. Entry at the hourly 0 cross, stop loss below or above the divergence swing, and we're going to see that on the chart. 20-hour SMA above 50-hour SMA again. Okay, when we are going to close the position, when we have the opposite crossover change, and then you also have the daily MACD crosses above the 0 line. All the daily MACD crosses below the 0 line. This is going back to the day. Okay, now let's look at this, for example. This is again dollar CAD, right? Look at this. Over here we're going up, right? We're going up. This is an extended trend. and we have a divergence signal because prices are going up while the momentum is slowing. And over here, I marked that point because this is exactly where the MACD turned to 0. Okay, this is exactly our point. Now, look at this. The 20-day SMA is way above the 50. Okay, that's what it means. You see the distance between the two MAs? You can call it lambda. Actually, this is the more of the algo training word, where developing strategies is called lambda, the distance between these two, or you can call it anything you want. D for distance, doesn't matter. And you have also the fast EMA, of course, crosses below the slow SMA, because this also happened over here. So, and this is when this appears. That's why I said I will explain to you how this works. When the fast EMA crosses below, this is when you get that red dot, or the opposite would be in the green case. Now look at this. We are down on the hour, on the hourly chart now. Okay, you see over here I have marked the area of the divergence that we also see on the 1 hour chart. Okay, so we'll go from there to there. We also need prices to go above. Okay, we also need the prices to go above the previous high to create the actual divergence. So that happened in 1 hour candle. So that worked okay, right? Now, the fast EMA crossed below the slow EMA, the zero cross. This is our entry. So in our case, this is the entry, okay? This over here, because we see the divergence on the daily, we'll confirm the divergence on the 1 hour. When we get the cross, this is the entry, okay? The exit, as I said before, the divergence swing, it should be above that high, okay? And this is the divergence swing. Above that high should be our stop loss, and this is a short position, of course. Now look at this. We open that position and we'll let it go down, okay? It goes and it gives us 263% again as an actual percentage of reward, which is very similar to the previous strategy. But our exit is at the daily crossover. You see, we have been negative all this time, and this is what matters. The moment we turn positive, this is when we close the trade. And this is what gave us on the daily, I repeat, right? This is what gives us 2.63. Now let's look at the reverse / continuation strategy. The 20-day SMA above the 50 SMA, again, trend bullish, trend bearish, and the opposite case. Price rejection down to the 20-hour, lower Bollinger Band. This is a long signal. Price rejection up to the 20-hour upper Bollinger Band. This is a signal for a short position, but the trigger is different. The price is below the 20-hour, a low Bollinger Band, and we get the moving average crossover. That's a signal for a short. And then the opposite, of course, for a long position. The entry is at the hourly median, or the moving average, above or below the, depending on where we are. It's going to make sense when we get to the chart. Stop loss below or above the 50-hour moving average. Okay, 20-hour above 50-hour we close. 20-hour SMA below 50-hour. Again, this is the same sort of rule. And we're going to get 3 hourly closes under the lower Bollinger Band or the upper Bollinger Band for confirmation here. Okay, 3 hourly closes as before. This is the confirmation that we need. Now, look at this. We have the Bollinger Bands and we have the 1 hour chart here. Okay, of course, let's not forget the trend is to the upside because the 20 is above the 50. So we're only looking for long positions here. Okay, look at this. Prices broke above. We have the first breakout, right? And we have that leg to the upside, and we have a move down at the median. You see that? Prices down to the 20-hour moving average following a breakout, because you have the first breakout, and we use this method to ensure that there is going to be a continuation to the trend. But we do see the pullback. It comes down to the 20-hour, okay? This is the important thing. And now look at this. We get the rejection at the lower Bollinger Band. If we don't get the rejection, we see a breakout, there is no trade for us. We need that rejection because without the rejection, prices could go anywhere. Okay, we want the pullback to be contained within the bands. That's what is main point here. Now look at this. We enter at the lower band, yeah, when prices close inside the bands. Because here the breakout, you see the candle closes below the lower band. We need that return within the band. we need that return within to ensure that we are, well, to actually increase the chances of returning back within the sort of this trend, right? So we enter when the hourly candle closes back within the thing. And let's not forget, guys, we want to see one candle closing outside. The next candle should close inside. If the next candle does not close inside, you leave it. Okay, so we get the LBB on return. You see that after the LBB rejection, lower Bollinger Band rejection, the stop loss is just under the 50-hour SMA, and the 50-hour SMA is the red line. See, look at this. You come down here. Where's the 50-hour? Down here, exactly. So we'll go just a little bit lower. Okay, and the exit is when we get 3 hourly closes under the lower Bollinger Band. Okay, you see that? You got 1, 2, and 3. This is when we get confirmation, but for a bearish trend. Do you understand that? So the opposite breakout should be when we are closing our trade. This, because it's a continuation of the trend. If we get this, you can trade one of them like every week, and that's it. 344 return. Very good. Now, some tips. Obviously, we need to look at the MACD age. That means how many crossovers have taken place and how long ago the moving average crossover happened. Is it 5 hours before? Is it a week before? Because if it's a week, probably you get a lot of consolidation there. How many crosses failed? We have to look at the most recent history. Go to the previous cross, okay, and see, did it play out or not? If it played out, that is positive for that particular signal. If not, it's not. The MA is distance. What is the distance between the actual MAs? Okay, larger signals pull back. Okay, the larger the distance, that means we're most likely going to get a pullback. Okay, oops, sorry. And of course, do all indicators point to the same signal, which is very important. And this is what brings us to the combination of all strategies together, all in one. 20-day SMA above 50-day, trend bullish, the opposite for bearish. The RSI, the MACD, go overbought and then oversold. That signals a long position. And then, of course, the opposite for the opposite position. The price goes below the moving average crossover level, but not the swing low, and forms a divergence. You will see that is something similar to that we did with the Bollinger Bands. We wait for one thing to happen. That is our precondition. Then we enter the trade. The exit, the entry is at the next RSI or overbought or oversold. The stop loss below the or above the hourly lower band or upper Bollinger Band. 20 hours SMA below the 50, 20 hours SMA above the 50-hour, okay, SMA, and exit when the daily fast MA crosses below the slow. Now look at this. Again, dollar cut. Everything has happened on dollar cut, guys. When we look, of course, at the daily, we do know that the 20-day SMA is above the 50-day. We don't need to see to show it every time. And here we have the crossover, yeah, that happened. Well, for this particular case, the crossover on the daily and the 1 hour is exactly at the same level. But it doesn't matter. Anyway, what matters here is that we saw the first breakout, okay? We come here, and what happens? We are going up, as we said with the RSI, we need to see the first RSI oversold. We are looking for long positions. RSI goes to the overbought territory. And then, what is the idea here? To let it go back to oversold, okay? Boom, nado. There you go. It goes to oversold, and then back to overbought, okay? And then we see the moving average cross, okay, to the downside this time. Now look, the MACD also goes below over here, okay? You see that before we actually see the moving average crossover, okay? So we get one oversold RSI and the MACD crosses below. So we'll have the breakout. This is good. We'll get the confirmation that we are having a pullback. This is good. Second step. Third step is to go and take out the crossover level. This is the crossover. We have to go below that level, okay? But just going below is not enough because it can continue lower, which means we did the right and we didn't enter that trade. We need to go back up, okay? That is the main point. We go below our moving average crossover, okay, after the RSI overbought, after oversold, and after the MACD crossover. Okay, now over here, one of our signal is the MACD crossover of the EMAs again down here, and the divergence. You see that divergence over here? You've got from there to there, prices going down, and from here to here, the divergence is showing, you know, that prices should go up, and boom, breakout. This is our entry. Okay, this candle, yes, it looks huge, but this is the actual entry. The entry is the crossover candle, guys, okay, and return back within the moving average crossover that we've identified as the potential signal. This strategy is a bit more complex, but if you work on that detail over here, it will be so easy to follow. I will remind you, you get the breakout first always, then you get the pullback, and that pullback has to take out the moving average crossover and then return back above the moving average crossover level, okay, after we see divergence on the MACD. That's it. That's the right moment. Stop loss is below the lower Bollinger Band. You see that? This is the one over here. That is the one. The entry over here, as we said, and the stop loss. Look at this. And we're going to go on the daily again to do the exit. Look at this. Now, this is where we entered, guys. Okay, this is our entry. As you see here, our stop loss is just below the Bollinger Band on the 1 hour. It comes also below the Bollinger Band on the daily, which is excellent. And then we'll let that go up until the crossover of the daily moving average, as we saw in the moving average trade before. And this is pretty much, guys, giving us a 5.20 risk reward ratio. But let me tell you, it's not 6, you might say, but let me tell you this. All of the indicators are using, they have a different value added to this particular strategy. And it's like the combination of these indicators with the moving average. This is exactly what gives you everything you need to have a strategy that doesn't just look at trends or breakouts or false breaks or continuations or pullbacks, but it looks all of it together. The market cannot get away with this strategy because it looks at everything. Okay, now I want to thank you very much for paying attention, guys. Okay, it literally has been one of the webinars that I really enjoyed telling you about, because I have been, this is how I actually got involved in trading back in 2013, 2014. Okay, these also strategies, specifically the one using the Bollinger Bands, are coming from institutions. Okay, so any questions? Now is the time. I will give you a minute. I will be silent for a minute, and I'll see what sort of questions you might have for me. If you don't have, of course, any of you remember later that you had some, or if you're watching this recording, do not hesitate to send an email to marketing@F4 Markets, and the guys will reply your questions, I am sure. So I will go silent for a minute, and I'm waiting for your questions. Okay, Mubarak, thank you very much for the comments. I'm glad to help, and I'm happy that you are open with your concerns. And yes, as I said before, you do not need to combine all of them together. Actually, the best thing for you, and what I would suggest, if you find the use of three different indicators quite overwhelming, the best thing is to do indeed start with one at the time. Okay, you can, based on your style, decide if you want to trade breakouts, to use the RSI strategy. If you want to trade pullbacks and continuations, to use the MACD and the Bollinger Band strategies. And if you just want to do reversals, to use the MACD strategy. So this is my recommendation to you. Yes, ISO, you can, this is the response to you, yeah? You can use any of them. You have three strategies that they are using just one indicator and the moving averages, and you also have the combined strategies together at the very end, all in one, where you should, I mean, the ideal scenario would be for you to end up, because of how much you will practice and how much successfully you're going to use the previous three strategies, end up coming and using that all-in-one strategy in the end, combined with ease rather than getting overwhelmed. If you get overwhelmed, forget about it. Just stick to the one. I'll wait one more minute for more questions. If there aren't any, you feel free to send them to marketing@informarkets.com. You'll receive your response. I'm glad you got the point, Mubarak. Happy to help. Yes, no problem, Mubarak. ISO, yes, you can watch the recording. Feel free to email marketing to ask for it or for more details. And Mubarak, you can use we can use any of these indicators the way I am using them to complement your own strategy. But what I would recommend, okay, is that to remember that the RSI, the way I use it in this particular case with the moving averages, okay, it's for breakouts. The MACD, it's for pullbacks and reversals, and the Bollinger Bands, it's for pullbacks and continuations, okay? Because if your own strategy, for example, if your own strategy is trading sideways markets, then probably the MACD and the Bollinger Bands are the one that you should be using. You can take any of the information and the way I'm using these particular tools within the same context and just apply them to your own strategy and see if that works for you. You have to backtest. Without backtest, it's it's not a good situation. MA and RSI, yes. I mean, the moving averages for the RSI, we just mainly look at identifying where the trend is. So we always go out on the daily and we look where is the 20 daily SMA versus the 50 daily SMA. If this 20 is above the 50, we are looking only for long positions. If the 20 is below the 50, we are only looking for short positions. If the above or below is not too wide and we see some sort of sideways consolidation, we do not trade that particular asset. Okay, I hope that makes sense. The MAs are mainly used to identify the trend direction in the RSI strategy. and in the market strategy. Also, in all the strategies, they use it for entering, not for entering, for exiting, I would say, mainly the crossovers. We use the crossovers for exiting. In the market, we use the zero line for exiting and entering too, okay? And in the Bollinger Band case, let's not forget, the median line of the Bollinger Band is the actual moving average, so it's also used for confirming an entry, confirming, I repeat, okay? And then you use the lower bands and the upper bands for entering. I hope this makes sense. So if there's no more questions, I want to thank you for being with me today, of course, and I will be happy to host you again in our next webinar next month. Details to be followed. So thank you again. Enjoy the rest of your day and take care.